It's been a busy week for central bankers, but where will they go from here? Markets have rallied confidently after the Federal Reserve cut rates earlier this week, although Chair Jerome Powell tried to pour cold water on the most excitable hopes of dramatic easing before the end of this year. Elsewhere, the Bank of England stayed on hold amid still high inflation, and the Bank of Japan's board members sounded noticeably more hawkish, suggesting the bank will phase out its massive monetary stimulus sooner than markets thought. Well, Carsten Brzeski is Global Head of Macro for ING Research. Carsten, the market seems to be celebrating the Fed move, but Chair Powell was actually quite cautious in his language. Is the market anticipating more cuts than we might really see?
I think that is exactly what is happening. So the market seems to believe that there will be more rate cuts, that it will be more aggressively than what Powell said. And somehow the markets are underestimating currently that Powell also said, that the U.S. economy is still going well. Powell also said that there is still, a relatively high inflation. When you look at the dot plot chart, I think the Fed currently expects two more rate cuts by year end, but market is, I think, expecting a more aggressive rate cut series by the Fed. And in all honesty, the market might be right, because when you look at the U.S. labor market, and we know it has started to come down, and not only slowing down, but when you look at manufacturing, there are jobs disappearing. So no story about returning manufacturing jobs to the U.S. economy. So losing jobs already. And I think we also know that once in a big economy, the labor market starts to slow down, it really takes a while before this thing is turned around. So it could very well be that the U.S. economy surprises to the downside, and then the Fed will have to deliver more aggressive rate cuts than they currently believe themselves.
The Fed is also, of course, coming under intense political pressure to lower rates faster. The Trump administration is now taking its attempt to fire Governor Lisa Cook to the Supreme Court. What would it mean for the global financial system if Fed independence is threatened further?
Well, of course, it would be a big shock to the financial system, because the U.S. economy is the most important economy globally. The Fed is probably the most important central bank in the global economy. So if there were really signs that this Fed would no longer be independent, it would be a shock to the financial system, and it would also be inflationary, because we know from literature and from research that in the end, central bank independence has been an important driver of bringing down inflation globally in developed markets over the last decades. Having said all of that, Elena, I'm still adding some kind of caution here, because it is not that Donald Trump is talking about nominating Joe the Plumber to the Fed. It is really so we're still talking about potential candidates who have an economics background, who have a central banker background. And we also know that, 8 years ago, it was actually Donald Trump who appointed Jerome Powell. So I think we also should keep things calm and just see really whether any nominations coming up are really substantially undermining Fed independence.
President Trump, of course, has spent much of this week here in the UK, where the UK and US signed a number of key deals on tech and AI. What does that say about the US relationship with the UK, and indeed its different one with the EU?
I think that was a very important development this week, because it showed that despite some discontent on geopolitics, the US and the UK are working together on extremely important economic files. AI, tech, it will be the future. And the fact that now the US and the UK are working together will not only benefit the UK economy, but at the same time, it could probably will push the UK economy further away from the EU. Because contrary to these good deals that the UK has now been negotiating with the US, the EU and the US are still more or less on a kind of collision course. Now, we have this very weak trade deal. On other policy areas, we haven't seen any agreement yet between the EU and the US. So I think that is also, when I compare now the continental European situation with the UK situation, that is another reason that could lead to more divergence between the EU and the UK.
Despite what you called a very weak trade deal there, though, the Eurozone continues to surprise to the upside, doesn't it, with the consumer in particular looking stronger than we expected?
Yeah, even though I would be a bit cautious because it is consumer sentiment that is improving. It is not really consumer spending. And as we are also seeing the labor market in a couple of European countries turning, plus we have this discussion not only in France but also in other European countries about potential austerity measures. I find it hard to see that European consumers will really open up their wallets. I'm a bit afraid that we have had so much positive sentiment coming out of Europe since the start of the year, be it German fiscal stimulus, be it the efforts to boost the defense industry in Europe. I'm a bit afraid that we could see negative surprises towards the end of this year as Europe will not be able to fulfill these very high expectations.
That was Carsten Brzeski of ING. Don't forget, you can watch more videos on Reuters.com.